Every intermediate trader knows this scenario. The market loses momentum, and price action begins to bounce aimlessly within a tight horizontal channel. This animated diagram shows exactly what happens to traditional trend-following tools in these conditions. Because they rely on sustained momentum, indicators end up signaling buys at the top of the range and sells at the bottom. You are left with two bad choices. You can sit on the sidelines and wait days for a breakout, or you can take a barrage of small losses trying to force a directional trade that simply isn't there. Applying directional tools to a sideways market is a mechanical mismatch. To survive the chop, you have to stop trying to predict where the market is going. Grid trading is built for this vacuum. It ignores market direction and strictly harvests volatility itself. This diagram illustrates a grid on a ranging market. Establish a central price, deploy buy limits below it, and sell limits above. As price oscillates, it triggers entries and automatically secures micro profits on each reversal back through the grid. It is highly effective, but you must hand execution over to an automated machine, and you have to know exactly when to pull the plug. Building a successful grid requires precise math. First, establish a central price point to act as your anchor at the expected midpoint of the range. We determine grid distance using the average true range, or ATR. It measures volatility to set precise spacing matching the market's rhythm. The system then locks take-profit targets directly on top of adjacent lines. Buy orders close exactly at the next level up. A successful grid is an exercise in exact mathematical spacing. It deliberately removes human prediction and human emotion from the equation. Executing a structure like this manually is impossible. You would need to monitor charts continuously, calculating and placing dozens of simultaneous orders without hesitation. This necessitates an expert advisor, or EA, running on a platform like MetaTrader. The EA handles the initial deployment, manages the take profits, and continually balances the active positions. In grid trading, automation is not an optional luxury. It is a structural requirement for keeping the math perfectly aligned. A flawless algorithm will still collapse if you deploy it in the wrong environment. Grid trading requires currency pairs naturally prone to mean reversion, like the AUD entity cross. We identify a valid ranging environment using Bollinger Bands, looking specifically for flat parallel lines acting as a ceiling and floor for price action. We verify the absence of a trend with the ADX. A reading consistently below 25 confirms the market lacks momentum. When these environmental criteria are met, the automated grid functions as a highly efficient extraction engine. But markets are volatile. A sudden market shock, like an unexpected central bank intervention, can instantly destroy a ranging environment. The previously flat market breaks out, forming a massive, sustained directional trend. Price surges in a single direction without any of the pullbacks required to hit your take-profit targets. This animated diagram visualizes the catastrophic failure. The price line rockets upward. The automated grid blindly continues to open sell orders against the trend, causing a rapid spike in drawdown. The system fails precisely because it is executing the exact code it was given, driving the account directly toward a margin call. This is where we introduce the only viable survival mechanism, the master stop loss. This hard limit is programmed as a specific equity percentage, like 5%, or a fixed price level. When hit, it overrides the EA, triggering an instant liquidation of all open positions. Taking a small, mathematically defined loss is the mandatory price of preventing total account ruin. Quantitative traders evolve these systems further, programming their algorithms to dynamically widen grid spacing during high volatility, or building grids that trade with a specific directional bias. But even with advanced mechanics, this is never a set-and-forget system. It requires strict environmental identification and ironclad risk controls to function safely. With those rules in place, you turn frustrating sideways markets into a reliable mathematical playground. You can put this mechanical theory to the test risk-free on an FXNX demo account. Leverage their 0.0 pip spreads to maximize your grid's efficiency and see the automation at work.